Hey folks, David Frost, My Strategic Forecast. You're here for another episode of Common Sense Market Analysis. Today is Thursday, July 2, 2015. So we're looking at a daily chart of the SPDR, the SPY, and that was a pretty narrow range today, last day, trading day of the week. No surprises that it wasn't a wide band today. It was basically narrow. The volume wasn't terrible, but it was okay. 104 million shares in the SPDR. Not terrible, but not heavy volume by any means. So there's not much different than last night, but there are a few things that we can take out of the market. So let's go over some of these things now, see if they give us clues on where we're going next week, because really, there's two distinct scenarios that are right in front of us. And of course, the third one will play out, which will be nothing, right? It'll be, a flat day on Monday. But, you're going to have this referendum in Greece over the weekend. And, I hate the whole Greece thing, but nevertheless, if everybody's waiting for it and everybody's waiting with their finger on the trigger based on what's going to happen, then, it becomes a self-fulfilling prophecy. But here's the deal. So Greece is having the referendum, and they're either going to vote no or yes. And I don't even think the people in Greece know what they're voting on based on what I heard the referendum was in terms of the wordage in there. Very confusing, and that's obviously by design. And it's by design to get people to vote one way or the other, I would guess. Anyway, so Monday there's a high probability we're going to wake up and the markets are going to be going in one direction or another in a large way. That's a high probability outcome. Is it a guarantee? No, of course not. But it's a high probability outcome. So we have to go look at what the scenario is. And on the downside, you have the head and shoulders pattern that we've been talking about all week. Your left shoulder, your head, and your right shoulder. Here's the neckline, and we broke down from the neckline and stopped at the 200 period moving average, retested it the following day, and then this is yesterday and this is today. Now, this was Monday. The big down day was Monday. The head and shoulders neckline has a target slightly below 202, but I put this in here, and the target is really in between these two areas. There's one more number lower that I've been giving you, which is about 1980 on the the ES contract, the S&P futures contract, 1975 to 1980. But that has nothing to do with the head and shoulders. That's a separate and distinctly different calculation that I have. So that's it's not a downside target, but should we get down there, that would be great support and most likely a buy area. There's a difference. A downside target would be an area where I believe the market's headed and should get there, or an upside target, same thing on the reverse, right? But if we were to get below 200 or 2,000 in the S&P, right, then I think the 1975, 1980 on the E-mini contract, which would be about, about 197.50, 198 on the SPY, which is right down here. That's another area that would be very, very good support. In fact, I don't know that we'll get there, but I have the number, just like I had the upside target from months and months ago of 2035 on the E-mini contract, and we got to 2034 like 6 months later. It's one of those things, and I'm not saying it takes 6 months. I'm just saying sometimes those numbers are unfulfilled for a period of time, and what we call that is an unresolved position. So we had a 2035 on the upside in the E-mini contract, and when we didn't get there, and I think it was even given to you guys last October, and when we didn't get there, it was an unresolved position for a long period of time up until in May or June or whenever we were there. It was May. It was the third week in May. So this may or may not be one of those things, but we'll see. But here's the deal with the head. So the flip side is that if we come down, right? So right now on the SPDR chart, we're failing at this neckline, okay? We came back and we retested the neckline this morning and failed. That's a negative sign, okay? Make no bones about it. However, there's something very, very interesting which I want to bring into the picture. Now, I was going to bring this up last night, and I didn't on purpose because it's just, you'll see in a second. Let's first go to the S&P 500 cash index. Okay, this is different than the SPDR. The SPDR is an ETF that you can trade. The S&P cash index you can't trade. It's just the index. Now watch this. Okay, here's your neckline. Okay, does it look different than the SPDR? Where did we close yesterday and today? Above the neckline. Now, any close above the neckline should produce a failed pattern. And remember what I've been telling you the last couple of days. If the pattern fails, you can most likely get a move equidistant to what we would have expected on the downside, on the upside. Not guaranteed, but it certainly would head that direction for sure. Okay? Now, that's interesting, right? Now let's look at something else, and then we're going to talk about it. Here's the E-mini contract. Now, I've already did this one for you. I did this earlier. Again, yesterday and today in the futures contract, we closed above the neckline. So here's what we have. We have three indexes that all follow the S&P. We have the S&P futures, we have the S&P cash index, and we have the SPY, which is the ETF, the SPDRs. Okay? 2 out of the 3 indexes closed above the neckline. I really would have liked to see 3 indexes, folks, but we got 2 out of 3, and that's why I didn't bring it up last night, because I don't know how to read that. I mean, is 2 out of 3 okay? Maybe. I don't know, but it's nothing definitive that I can say, well, because we got 2 out of 3 close above the neckline, then I'm good to go and we're going to go higher. I don't believe that yet. I have to see more evidence. I have to see the SPDRs close above the neckline in order to say the head and shoulders pattern is off the table and we're going higher. So we don't have that, unfortunately, but this is what we have, and so I'm giving you both sides. I hate to do that. You know that. You know I like to give you a direction in the market. You know I like to give you numbers, targets, the whole 9 yards. From time to time, and we're in one of those times now, I just can't do it. I just can't with conviction say I'm 80% sure that we're going in this direction. I can't do it, so I won't do it. So we have to wait for the market to resolve itself. We need more evidence one way or the other. And the evidence is going to be either the other 2 indexes, or I'm sorry, the S&P cash index and the futures close back below the neckline, at which time I'll say that this is going to play out on the downside, and that would begin Monday most likely. And it doesn't all have to happen in one day, but it certainly could. And then your second piece of evidence is closing below Tuesday's low would almost be 100% sure that we would play out down to below 202. Okay, that's one thing I could say. Or on the flip side, if we get 3 out of 3 indexes closing above the neckline, then I'm going to say it's a buy and it's bullish. So if the third index, the SPDR, closes above the neckline, it's a buy, along with the other 2. And if the other 2 close below the neckline, you're going to look for the 202 to 201 in that neighborhood target, maybe down to 200. We'll just say in this range. All right. Bear with me. Let's see if I can do this. In this zone, okay, we're going to go to that zone if the other 2 indexes closes below the neckline, and that's where we are. So we'll know more Monday. I think this thing will be playing out one way or the other Monday, and that should resolve itself, and that's where we are. All right, I know I spent a lot of time on the S&P. I apologize, but all in all, I'm trying to give you everything I have, and I'm trying to explain it the best I can so that you folks understand everything I understand. So that's where we are. Let's go to, here's some evidence, right? Remember last night we talked about the IWM, And if I can get the chart to populate here, I can't get my IWM chart to pop up. I wonder why. Oh, because I have the, pardon me, folks. Just bear with me. Okay, here's the IWM. Now, last night I said the IWM was weaker than the S&P, the SPY, right? And I said that's something of note. We have to be aware of that. Well, today, okay, the IWM was down $1.21 or almost 1%, 97 basis points. And basically the S&P, let's see, the spider was flat. It was down 0.1%. That doesn't even count. That's a rounding error. It was flat. So that to me is also alarming. However, sometimes it's just a fake out, and we just won't know really until Monday what's going to happen one way or the other. I think this is going to be resolved on, and I don't mean Greece being resolved. I mean the market resolving itself in one direction or another, okay? So where's your downside in IWM? Well, you're actually pretty close, because if you look at all this area, okay? What we know, okay, if you've been here for any period of time, you know that we look for previous areas of chart support, and this is basically called vibration, okay, where the bulls and the bears had a fight. Let's just say that, okay, or not necessarily a fight, only you can just see where the market kind of chops around and is looking for a direction. Same thing here. That's called vibration, and that's a Gann methodology, and you can go look that up and, and learn something. It's very interesting stuff. It's a little complex, but it's interesting stuff. It's all based on numerology. And here's the deal. So all this chart support here should provide a level of support for the IWM right in this area, 122.50 to 123, in that neighborhood. But if that didn't hold, then you could be looking all the way down here at this double bottom at 120. And that's, that would scare some people, because another $3 to $4 down would also mean that the S&P 500 head and shoulders pattern was playing out. So we look to this index for evidence, and the evidence tells us it's weak, but we still have to wait till Monday for the whole thing to resolve itself, and I'm pretty confident that it will, one way or the other. Okay. The VIX. The VIX was up a little bit today, even though the main indexes were basically flat. You know, the Dow was down 27 points. The S&P was down less than 1 point. So that doesn't count. And the VIX was a little bit nervous. That means people were buying protection into the weekend, protecting against a collapse after the announcement and waking up to an all-out collapse. And that's certainly possible. And I don't mean collapse. I just mean, if the head and shoulders pattern is going to play out, or even a little bit worse, remember, that's going to be a buy area, okay? That's not an area to run away from the market. That's an area to run to buy it, because the market's probably going to rally pretty hard after that, okay? Now, I'm not going to say we're going to make new highs after that. We're going to have to recalculate and come up with new numbers that may be an upside target before this market turns again. And we know that the market is most likely going to turn for a real correction soon. Okay, we're getting closer, but we're not there yet. We have plenty of time left for a rally, and we want to see it play out. I'm not going to give you a date or anything like that yet. It's not important. I don't want people jumping the gun and start buying shorting stocks and buying puts and all that stuff when we could be in the face of a rally coming. So I'll wait to give you the date. It's no time soon. It's coming, but we've got plenty of time left. Okay, let's go to gold. This is interesting. I want to show you what happened today. So this daily chart of gold, this morning, early in the morning, right? This is basically in the pre-market. Let's go to the intraday, okay? And what time it was, whoops, I hate that. What time it was 8:30 in the morning. Gold hit a low of 155.80. Let's go back to the daily chart, okay? How long has this 155 been in there? Okay, we missed it by 80 cents. That's pretty good. Now, Do I think gold's going higher or lower from here? I don't know. But what I can tell you is that we didn't close June above 1174. And remember, I was saying that for at least a month, that we had to close the month of June above 1174 in order for gold to be put in a bullish position. And it closed below, and you see what happened. Now, all of a sudden, we closed. We were at 1170. Here, what day was this? This was on the 30th, okay? On the 30th, or even the 29th, okay, we were as high as 1187. On the 30th, our high was 1180. And today, we were at 1155. Okay, that's $3 in the GLD, $30 in the price of gold, or more from the day before, even a lot more than that. So you see the power of these numbers play out. Okay, that's why this was a red line. Okay, it's a very, very important number. Can we recapture it? Sure. Sure we can. However, the fact that we came down to test, we didn't hit, but we tested 1155, okay? Now here's the way I look at it. We didn't get to 1155. We came up a little bit short, and we bounced higher. That's bullish, believe it or not, in the big scheme of things. It's bullish that we didn't hit 1155 and came up short. But it's bearish that we didn't close above 1174 for the month, and the market immediately turned down. You can see that. You can see the power of that number. And it brings into play one more number that I have, which is 11. Oh, it's not even here. Let me see if I can bring it up on the monthly chart. Yeah, no, it's too low on the chart. It's 1130. Okay, 1130. So that's another, $25 down. So we'll have to see. There's no trade here right now, because now all you'd be doing is guessing on a direction, and we don't do that. We only take trades when we have the probabilities in our favor. Otherwise, we keep our capital in our pocket, because capital is the only thing we have. If we don't have our inventory, which is our capital, right, then we can't be in business. So we need our inventory to be in business. Capital is the inventory. I'm not going to guess on a direction of gold. If we recapture 1174 and begin to, firm up and trade higher in the month of July over and above 1174 and start to put in a bullish pattern, yeah, I'll absolutely trade that. If we start to put in a bearish pattern under 1174, would I trade that to the downside? Yeah, but we don't have that right now. All we had was 4 down days in a row into 1155. That's not really a pattern. There's nothing to trade here right now. Okay, let me give you this example. You see this here? This was from. I hate that. Why does it do that? This chart. From the 24th, 25th, 26th. See how it began to go sideways? If we had another 3 or 4 days of moving sideways right underneath the 1174, that I would have traded down to the downside. However, this just basically scaled downward, so it didn't give us a pattern to trade. It just gave us lower prices. So there's nothing to do. Okay. Oil. So I was telling you last night that oil had a target in my work of $56. We didn't get there today. Actually, we got the oil market reversed earlier, and then it reversed back down. And we had a high of 57.95 and a low of 56.50. That's a pretty good swing. Let's take a look at the intraday. I'll look at the hourly chart with you. You can see what happened. That's a pretty good swing in the price of oil. But nevertheless, we finished down at 56.55, and to me, we're very, very close to the downside target of 56 I gave you last night, and I would think that we get there, and that would be, remember what I said before, that would classify as one of those unresolved positions. So I've got a price target of 56. I think we get there. Don't trade it from here. It's not enough in it. But when we get there, I believe the market may firm up, and we may be able to find a pattern that's going to give us a bullish pattern for higher prices. But until and unless we fulfill 56, I don't want to do anything, or unless we reverse and begin to get over some of these other hurdles that we have in here. So right now, we're basically in a no-trade scenario in oil also. But that market will clear up like they always do. Bond market didn't do anything today. It was basically a pause day. We're we're hovering above this line for too long. So even though we've had a rally off this line, this was a weekly support, and I'll just refresh our memory on where this came from. Oh, was it a monthly support? Yeah, it was monthly. So remember, if you've been with me for any period of time, you'll remember back in January. Okay, was this January or February? February. Back in February, when we put in this big reversal bar, okay, reversal candle. Okay, remember I said that was going to be it for the bond market. I said that may be a top for the bond market for a generation. And I think that is the case. And you can see what's happening here. We came down this was not a down month, but it was down that month. I'm just going to count it. 1, 2, 3, 4, 5. We had 5 down months in a row, 5 tough months in the bond market, okay? We're hovering above a very, very important level. This 115.43 in the TLT is an extremely important level. And it becomes obvious it's important when you look at the daily chart and you see we hit it once, we hovered over it twice, we pierced it and recovered 3 times, we hit it a 4th time. That tells you it's very, very important, okay? And remember, that line was in here long before this first hit ever came. And the more you hit on this line and the more you trade right above this line, let's say in between the purple line and this line, the more likely this line is going to break. Okay, so if that's the case, let's take a look at the flip side that we've been doing lately. This is the yield. Okay, so this is the 10-year Treasury note yield. It's not exactly, I showed you the TLT, which is the 20 to 30-year bond, but I'm showing you the 10-year yield because it's the more prevalent yield. It's the widely accepted use or widely accepted yield to discuss. So we're looking at the 10-year yield, and we're in an uptrend. We're in a pretty good definitive uptrend. Okay, basically, I think that we certainly have seen a generational low in the yields down here, which would mark the high in bonds. Okay, now how high do these yields go? Let's go to a longer time frame. Let's go to a weekly chart and take a look. Okay, and you can see this is a pretty steep upsloping trend line, but it looks to me like it wants to get up to 2.6. Right up here at around this area here. You can see, remember before I talked about vibration and all this chart support, this vibration here, all in here. When you see a chart pattern or you see a chart of a stock or yields or a commodity or bonds or anything, it doesn't matter. When you see a long sideways consolidation for weeks and weeks and weeks, right? So this is 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13 weeks, 14. I can even count this one. 14 weeks, okay? You see sideways consolidation for 14 weeks, okay? 4 or 5 weeks, 1, 2, 3, 4, 5, 6, 7 weeks here. That tells you that that market thinks that that price level is extremely important. And what that would mean is that once we got back to that price level, it would normally want to pause there and go sideways again. That's just the way, or pull back. That's just the way it works. And you can see that play out here, okay? You kind of got up to it here, pulled back, okay? You're getting up there again, and I would expect it to either move sideways or pull back. But this upsloping trend line is going to keep yields intact on the uptrend, and it's probably going to keep bonds in a downtrend. And that's the best analysis that I can offer you, on the bond market. So let's move on. The dollar. The dollar was down slightly today. Last night I had told you I thought the dollar had a good. This is jumbled a little bit. Let's go back to the daily chart. I told you the dollar potentially had some upside to this 97.75. Now, we haven't seen that yet, but there's nothing that says we can't see that next week. And the reason I brought that up is because, I do calculations from time to time, not from time to time. I do calculations all the time. From time to time, I give you price levels. And when I give you price levels, it's generally a target. So I did a calculation and it came out as a target, but remember, okay, I said we have to close above this high here, which is 96,695. Okay, so until and unless we close above 96,695, this doesn't come into play. If we do close above that level, then this becomes a very high probability of getting hit, and that's why I put it in there. So you'll just note that. If you want to play the dollar, if you're a currency or Forex player, you want to do something like that, that's fine. You can play it through the UUP, which is an ETF, or you can just listen to me and say, I don't play the dollar, but I like the analysis, and that's fine too. Okay, let's go to, and by the way, it doesn't matter whether you play the dollar or not. Hopefully, you're getting a lesson, and that's why I draw out some of these some of the charts that I put up here. That's why I draw them out, not draw on the chart, meaning that's why I take extended period of time to explain where I'm getting some of this information from and how I derive it, because I want you to learn. Okay, I want you to understand how to read these charts, because most people don't know how to read them. They think they do, and they're, you know, all the textbooks out there and all the courses out there and all that stuff. Most of it is just nonsense. Most of it works about half the time, and I can flip a coin or play craps or blackjack for something that works half the time. So, you know, I just want you to learn, because there's the value. It's the bring a horse to water, but I can't make you drink. If I teach you, you can be successful on your own. You won't need me anymore, and that's fine with me. That's my success, is if you're successful in learning everything that I know. And over time, each and every night, I try and teach you little by little what I know, and I'm kind of doing a long-term data dump, and that's my goal. Okay, should we look at natural gas again? Natural gas had a wild day also. Let me look at the intraday, because I saw inventories came out. Look at this spike, and then it goes all the way back down. And remember last night I told you it's the Widowmaker. I mean, look at those swings. I mean, who's trading this successfully? This is a very, very tough market to trade. I can trade it long term, but intraday, extremely tough market to trade. This would normally be a bearish pattern. It fails, and it goes all the way up here. This would normally be a bullish pattern. It fails, and it goes all the way down here. It's not something I want to trade intraday, that's for sure. You kind of have to know where you can be successful and where you can't. And longer term on the daily chart, though, this is a bullish pattern. So you can see today, very, very important, we closed above both moving averages. What does that tell you? The market is in a stronger position than it was yesterday. Okay, yesterday I think we closed below the 50. Today we closed above the 20 and the 50. Okay, wait. This is the third. This is the second. Okay, yesterday we closed below. Today the high was the close was 2837. The 50 was 2842. Slightly below the 50. Today's close. This is already calculating from the electronic session into this little candle here. That's really tomorrow's session. We're into tomorrow. Once the pit session closes, the electronic session goes. This is tomorrow's action. But we're above the moving averages nonetheless. So that's positive for natural gas. Natural gas is in a bullish position. This is an up move, sideways consolidation. Hopefully we'll get another up move for those that are bullish and long natural gas. All right, I know this was extremely long-winded today. I apologize. I'm trying to do the best I can to do it in a reasonable period of time. But when I get on a tangent, you know how it goes. And I'm trying to teach you, and I know we spent a lot of time. We almost spent 10 minutes on the S&P today. So there you have it. The markets are closed tomorrow, no video, but have a great holiday weekend if you're here in the U.S. If you're not, it's the Independence holiday, and therefore the markets are closed tomorrow. So we'll see everybody again on Monday. Thanks for tuning in. I'm David Frost.